Hey guys, if you hear, you probably landed on our website, Trade for Freedom. My name is Avi and I'm a full-time trader, and I'm doing this full-time. Currently I'm speaking from the beautiful beach in Thailand. The only way I can allow myself this life is trade for freedom. In this point, I want to introduce you to my partner.
Hi guys, I'm Ash, aka the Countman from Trade for Freedom. So I've got 20 over years in technical trading experience, and here I am today to share with you guys on some of the strategies that we have developed in order for us to generate income through trading options. So here's the idea. Many people think buying stocks and waiting for the stock price to go up is how they would make a profit. Well, technically they are right, but there are many other better ways to make a profit from the stock market. One of the main trading strategies we use in Trade for Freedom is the wheel strategy. Basically, we enter into a cash secure put contract for a particular stock that we would like to purchase, but at a discounted price. So example, stock XYZ is at $50 right now, and we enter into a cash secure puts at $45 with a 30 DTE. DTE stands for days to expiry. That means when in 30 days time, if the stock stays above $45, the contract expires and nothing happens. But if the price is below $45 after 30 days, then we will pick up the stock at $45. However, when you enter into the contract, you will get paid a premium just to say that I'll buy this stock at $45 at the end of the 30 days periods if it goes below that price. In Trade for Freedom, our main strategy, our core strategy is the wheel strategy. So we will enter into cash secure puts, and while we enter into the contract, we get the premiums. So first and foremost, when we look at the chart, we would like to identify channels. Channels are essential in our trading strategy for cash secure puts, the wheel strategy. So right now, from the 1st of April until the 17th of April, although it has already happened, you can see a channel here. This is a bullish channel. So this is the middle part of the channel. I will draw the edges as well. So at the edges is where we look for all the overboughts and oversold. Okay, so edges are all here. Something along those lines. So how do you know if a channel is a solid channel? Okay, it has to have a minimum of 3 touches. So you can see 1 touch, okay, one on the bottom, 1 on top, 1 on the bottom, 1 on top, 1 on the bottom. So minimum down here we have 3 touches, and that is when you know a channel is being formed. One thing good about a channel is, and this is a bullish channel, so basically price is making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Okay, when price moves in the channel, it moves in a controlled movement. Okay, it's not overshooting, it's not breaking, it's in a controlled movement, which what we would like for our wheel trading strategy. So each time when the price reaches the edges, the extreme parts of the channel, there's the upper channel, bottom channel, is where we pay attention to looking to take a trade. So in this case, we are entering into a cash secure puts. So when the price comes to the bottom of the channel, so now at this bottom of the channel, we pay attention, and if we see some sort of candlestick rejection, we will get into a cash secure puts below the price. So for example, when around this area, we would enter cash secure puts at like $20. Basically what you're telling is it's similar like a buy limit, but the only difference is when we enter into a cash secure puts, we get paid a premium upfront. All right, so if it's $20 we enter into one contract, it's going to worth $2,000. All right, and for BMNR they pay anywhere between 8 to 12% on the premiums. So basically by entering into this contract, and let's say it's a 30-day contract saying that you will buy the stock if the stock goes below $20 at the end of the 30-day period, and you get paid, for example, 10%. So there's $200 the market will give you upfront, and as the minute you enter into the contract, you get to keep the $200, just like that, just for waiting for the price to come down so that you can actually buy it at a cheaper price rather than just entering outright like that. Okay, so 2 scenarios that can happen. One, if the price stays above $20 at the end of 30 days, contract expires and you get to keep your premium just like that. If the price go below $20 at the end of the 20 days, and then you will pick up the shares at $20. All right, so that's a total of $2,000. However, you get paid a premium of $200. So essentially, you're only getting the shares, the stock, $1,800. So on top of wanting to buy lower, you're actually getting a discount on top of that. Never just buy a stock at the price itself like that. Just to share with you all, from this whole entire channel, the movement, for about 2.5 weeks, we managed to enter into 11 contracts at different prices. One of it was $20, and then we had another opportunity here, another opportunity here. So we had 11 contracts in a week. And so what is paid? So it's 11 contracts. So it's 11 times $20, which is $2,000. So capital required would be $22,000 in total. And then we would get a premium of an average about 10%. So that's basically 22,000 times 0.1, 10%. All right. So the market pays us upfront in total of $2,200. Okay. Just for saying that we will purchase the share, the stock, if the price drops below the price. So these are the premiums you get to keep outright. Okay. So in Trade for Freedom, we find these setups every day. So we take into account the technical analysis, the fundamental analysis, and the financials of the company, of the stock as well. So combining all these three, and also with our trading strategy, will always put us on the right side of the market. So basically, the cash secure puts premiums of a total of $2,200 that we pocketed last week, the 1 week alone, is one of the 3 ways of income that we can generate using the wheel strategy. Okay, one question I always get asked is, what happens if the price drops? Suddenly, from example, now the price is at $21 and it drops down to all the way to $15. So what do we do? Because we still have to buy the stock at $20 while the price is at $15. So how do we ensure this does not happen? This is when you need to come to our channel and we will explain to you how we select these stocks.
So that's our team. Join us and let's do it together. And I will see you on the Discord. Bye.